Hi, I'm Denise Anderson from Ibex Wealth Advisors. I'd like to welcome you to our market and economic outlook for 2023. Today, we're shooting from our new headquarters in Bedminster, New Jersey. We have a lot to cover, so stay tuned. There's no question that volatility was a defining feature of the markets in 2022, including a year dominated by surging inflation, Russia's brutal invasion of Ukraine, aggressive monetary tightening, and recession fears. What was particularly unique about this performance is that the bear market in stocks was accompanied by a bear market in bonds, making 2022 the worst year for a balanced portfolio since 2008, returning a negative 16%. The question on everyone's mind? Where do we go from here? Just as 2022 provided the markets with unique challenges, so will 2023. What is so unique about 2023? To start with, there is quantitative tightening. Recall that quantitative easing began in response to the financial crisis in 2008. The Fed began aggressively buying bonds in the market and providing stimulus to the economy. This policy tool is only used after typical monetary policy tools have been exhausted, and with rates at historic lows, quantitative easing provided stimulus and stability. The fourth round of quantitative easing took place in March 2020, continuing through the pandemic, and exploded the Fed's balance sheet with bond holdings. The Fed now holds $8.5 trillion in bonds. We are now entering a period of quantitative tightening. No more bond buying, no more stimulus. The pace of current tightening is approximately $95 billion per month, which is the equivalent of roughly 25 basis points of rate hikes per quarter. The result of this policy leads to increased volatility, reduced liquidity for borrowing, and pressure on risky assets. We've already seen some of the effects of this in the obvious asset bubbles. Things that come to mind are crypto, housing, and technology stocks. The implications of continued quantitative tightening are a reduction of risk appetite for speculative assets, less interest in financing big projects, and a return to more value-oriented investing. Bonds remain tricky except for the very short maturities. After years of the supersonic speed of stimulus, we are now in a period of aggressive braking. Selective investing with a return to fundamental analysis is going to differentiate performance going forward. As you know, we valued your feedback and have received some questions over the last few weeks that we would like to address. We have selected some questions that we believe represent the bulk and will answer them here. Susan, what's our first question?
Sure. Clients have asked about your market outlook for 2023.
Good question. 2022 was dominated by surging inflation and aggressive monetary tightening via rate hikes, which impacted the bond market and growth stocks the most. 2023 will start out much the same, with all eyes laser focused on economic data that measures inflation, like the core PCE. We call that personal consumption expenditures. It's a favorite metric of the Fed. If the data continue to show inflation falling, it will then open the door to the Fed slowing and then eventually halting rate hikes while they continue with quantitative tightening. If and when we reach that point, I have confidence, but no guarantees, that risky assets like stocks will perform well, liquidity will improve, and fixed income markets will stabilize. You can expect the next few months to be choppy until clarity emerges, leading to a better second half of 2023 with forward momentum to more normal markets in 2024. In terms of economic sectors, with mortgage rates more than doubling last year, I see pressure on housing and home building. I also see continued pressure on the consumer. Stimulus from 2020 and 2021 has all but dried up, and people are no longer feeling flush with cash. This could impact consumer spending, which accounts for 70% of our economy. Sectors we like going forward are the needs versus the wants, like healthcare, telecom, utilities, energy, financials, select technology names, and legacy wide moat businesses.
Now that rates have increased, are CDs and bonds viable options?
We shot a video in July of last year where we had touched on this very topic. For many years, income investors have been starved because interest rates are so low. In March of 2020, the yield on the 10-year Treasury dropped 32 percentage points before rebounding, meaning that if you bought a bond at that time, you were earning literally next to nothing for 10 years. All that changed last year with the Fed raising rates a staggering 425 percentage points. While that did significant damage to the bond market, it finally opened the door to higher yields for income-starved investors. I like municipal bonds as the income received is generally free of federal tax and if state-specific, from state tax as well. So to answer your question, yes, bonds are back and they will play a pivotal role in our portfolios going forward.
Another popular question we received is, do you see a recession coming for 2023?
Good question. A recession in the year ahead is a likely scenario, but like most recessions, by the time we confirm we are in one, it's in the past. Now, the fact that we are not in a recession now reflects unusually strong demand for labor. Any recession scenarios are likely to be limited in breadth to certain sectors of the economy. There is no getting around the fact that the population is aging, needs healthcare, and the digital revolution continues unabated. Cue technology. It's also important to remember the massive infrastructure spending that is underway, which will buffer downward pressure. Remember, not all recessions are alike. Consider the following. Employment is unlikely to weaken terribly due to structural issues of an aging labor force and reduced legal immigration. And for workers, lower inflation will help boost real wages going forward. There are convincing signs that an inflation downtrend is underway. For example, energy prices are down 20% from their peak. Other areas of weakening price pressures can be found in apparel, used cars, and even medical care.
We noticed a reoccurring theme, not so much a question per se. It was around worry and the overall worry that we experienced last year. Did you want to comment on that?
I was born a worrier, and I take my job as a steward of clients' investments very seriously. Investing is a very emotional thing, and when investors are worried or feeling gloomy about their outlook, their natural tendency is to fix it, and generally that means selling risk assets and stocks in particular. This is a dynamic of the market that I refer to as animal spirits. The hardest part of my job is talking to clients about staying invested through down markets, something that has proven to be part of a successful long-term investing and also moves the discussion away from timing the markets and towards good, sound investments. One indicator that I like to look at is the University of Michigan consumer sentiment. And if we look back over the past 50 years, we see 8 distinct peaks and troughs. If we measure subsequent 12-month returns of the S&P 500, we see that buying at a confidence peak yielded an average return of 4.1%, while buying at a trough returned 24.9%. I'm not suggesting that we will see that kind of return this year, but when animal spirits are overwhelmingly one-sided, things tend to shift the other way. We express nothing but gratitude for having the opportunity to work with you, and we wish you a happy, healthy, and prosperous new year.